John Knowles, Head of Capital Markets. We cover regional cities, offices, industrial, what used to be called alternatives, but now seem to form an increasing part of our workload. So that's students, hotels, a lot of development funding, structuring, joint venturing, and increasingly buying of more complex-looking portfolios in a search for yield.
Great, Alex.
Good morning, I'm Alexander Fischbaum. A little bit about me. In the UK for 20 years, as you can hear from my subtle accent, originally from Germany, and used to structure funds for ING, then was head of real estate mezzanine at Barclays Bank, and afterwards an investment director in Orion Capital Managers. And in that phase, I realized that there is a discrepancy between what the investor wants to do and what the credit officer gets on his desk. And that's what often creates confusion, and investors get terms back they don't understand, or get a rejection, or get the wrong pricing. And so we set up a little firm. Since 5 years, we are raising, structuring, and negotiating debt for our clients in the UK, Germany, Netherlands, and Spain. And we do this from senior to mezzanine, pref equity, and just help the banks and the clients get together to get the right terms at the right price and get the money at the right time. A few of the transactions we've worked on, just very briefly, we've just closed a 150 million acquisition in Germany, a very large complex portfolio. In the UK, interestingly, we see more demand coming back from the continent into the UK, but a lot in alternative sectors, hotels and student accommodation. And we also do some interesting work in the Netherlands and a bit in Spain. Thank you.
Hi, is this working? Yeah? Yep. Hi, Richard Divall. I'm based in London, but I head up our cross-border capital markets team for the EMEA region. Most of you know that Colliers is listed, truly global real estate. We're in 69 countries, over 400 offices. I personally cover the EMEA region, but travel around the world to meet the capital from APAC and North America, and then bring it and connect it to our teams around the region.
Great, Georg.
Good morning, I'm Georg Pfleiderer from Frankfurt. So I live in Germany. I think you can hear this easily. And so as you see from the label, I work currently for two companies, for TRIUVA and for PATRIZIA. So TRIUVA was bought by PATRIZIA at the beginning of the year, and so I work as a senior member of the PATRIZIA research team, and I'm also heading the TRIUVA research team. So finally, PATRIZIA is now quite a big player in the European market, and I think about 40 billion assets under management, and with a strong bias towards Germany. About 60% of our assets are in Germany, and but we are quite diversified in terms of type of usage. So we have a very large residential part, and also typical commercial part like retail and office, but also infrastructure. So we have caverns. These are subterranean oil and gas storage, and so it's a really diversified portfolio. So my personal career in the real estate industry started in 2005. So I think I had 3 turning points in the market so far. I think so I'm not a veteran, but I know how it feels when markets go down, and maybe some of the people here which are younger, they know only when things go up, and maybe this can change in the future.
Good, Simon.
Thanks. I'm Simon Martin. I'm head of research at Tristan Capital Partners. Tristan is a value-added opportunistic investment manager. Manage about 10 billion euros worth of real estate across the continent and in the UK. All the major property types and 14 countries, I think, across the whole region right now. Doing that now for 18 years with the same team of people.
Let's just start with you, Simon, picking up some of the things. So, I mean, yesterday in Paris, there seemed to be a real view of the Macron effect actually having an impact, being very positive. Germany safe and stable, Nordics, CE, very high growth at the moment. How do you see investor sentiment in general, and also specifically for the UK?
I think investor sentiment remains relatively robust right the way across Europe. I think our client base ranges right the way across Asia, the US, and into Europe. I don't see huge gaps in the appetite for European real estate within those cohorts. They all seem to want to do more here. I think they're all nervous about the cycle. The US group is probably more nervous than the others, simply because I think their market is more cyclically advanced. But I think generally they're pretty constructive and pretty positive about where the market is over here. We are, I think, running a much later cycle than you see in a lot of other parts of the world, and that for them means that it's an interesting place to come and do things. It's one of the few places on the planet where they can still pick up some of the aftermath of the effects of credit, and Europe, the European debt crisis obviously compounded that. So typically, I think they're realistic about where we are in the cycle, but still got a decent appetite for what we all collectively do. I think the only gap in that now is perhaps an increasing awareness that certain key gateway cities are getting pretty expensive, and perhaps the pricing in London and Paris and Berlin, when you're talking about a genuinely core building, which a lot of these guys are focused on when they're thinking about global gateway cities, is not that different to the pricing in New York or San Francisco or Tokyo or Hong Kong or Singapore. So I think that there's the market as a whole, I think they see opportunity. Their question marks tend to focus around, and certainly the way we tend to think about things is also tend to focus around justifying the very low cap rates you see in those very big cities. But that's not just a European thing, that's a global phenomenon across everything.
Okay, good. And Georg, Walter mentioned there a little bit about interest rates. Do you want to just pick that point up? We had the Fed yesterday raised by 1/4 point, but also suggested that there'd be 4 raises coming up over the next 12 months and 3 raises after that. You've got the European Central Bank today should be saying that they're going to stop supporting the, pumping less money into the economy. What's your sense of that? And is that having an impact in terms of your house view and also therefore your investment strategy?
So on interest rates, I think we are this quite similar to our opinion is quite similar to Walter's opinion. So we expect only a slow increase in interest rates, and so the purchasing program of the ECB, I think this will stop now, but this will take a long time to run out, and then finally interest rates may increase by end of the year, end of next year. But I think, for example, Italy showed that interest rates can increase much faster. So this small Italian crisis showed that interest rates can go up very fast, and the ECB can do nothing against. And when things on the real economy or on debt and so on are turning, then it shows that there's a lot of, so debt is still quite high, and there's possible that there's a lot of risk going out of this high debt. And so if the real economy may gets a bit weaker, and this can cause problems in paying back debt, and this can cause rising interest rates. And I think this will have impact on real estate too. So I think for the core economies, there's not so much risk. So I see more the risk that something in the real economy goes wrong, and this has impact on the rental market, and that the rental market gets weak, and this can cause yields to rise. And so I see more the risk on the real side, because a lot of economies are still not really competitive, and so if the cycle, the economic cycle goes weaker, so this economies may get back in trouble, and this can have impact on the rental market, and finally also on the investment market. Yeah. So I think the risk of that interest rates rise due to inflation and to monetary policy is relatively low.
Okay, good. Richard, just picking up some of those things. You're obviously looking a lot at the capital flows and also what the global investors are thinking about Europe and the UK within that context, and I'll come to John in a minute for the UK context. But yesterday we were in Paris, and Europa were talking a little bit more with Andy Watson about the fund that they've set up, Core Fund for Europe, seeded with capital from Mitsubishi, so Japanese capital coming in. What's your sense of that in terms of we heard from Walter about the weight of capital. Do you see that continuing? Do you think that there are still new players coming in? What's your sense of the sort of appetite from capital, particularly for real estate?
There's new capital coming in. I mean, it's not as though it's coming from necessarily a new region that everyone hasn't thought about. I've recently been on a big trip to Asia, and the Japanese, as you mentioned, are getting more active. They're obviously very wary of where we are in the cycle with their past experiences in the late 1980s and early 1990s. But they are very sort of just targeting the US, London generally, Singapore and Australia. So it's the transparency of those markets, the language, etc., that's probably dragging them in their decisions there. But probably the Koreans, insurance companies are probably the most active, I would say, at the moment. I mean, I understand that they've got a 100 basis points FX advantage at the moment, so currency advantage. They're looking at debt in the US because of where interest rates are and where the currency is. But for Europe, very much on an equity basis. So, buying core, generally offices and logistics around the region. But I was actually quite surprised how many of those groups are sort of looking and investigating Central and Eastern Europe, the Nordics, and Southern Europe, because I think some of them are finding, as Simon mentioned, pricing in Germany and France and fundamentals maybe in London not so appealing. But yeah, I mean, I think the Australians are certainly raising their head. We've had several groups over in London over the last couple of weeks. And I think, obviously Australia has never been in recession for over 25 years, so I think they're all strategizing how to go outbound. But yeah, I think capital from all over the world is still active. There's a new wave of Canadian pension funds who are investigating, but they all have very, very different strategies. I mean, the capital I'm sort of seeing generally has 4 strategies, and we've mentioned the core. So I think you get those investors that just want to come in and buy a safe, secure core asset in a London or a Berlin or a Munich, etc. But I think in this low interest rate environment and everyone chasing yield and return, there's probably a lot more capital going for the build to core or manage to core strategies. Obviously, as I say, in a low interest rate environment, that's quite appealing, but it's very key to make sure that you're teaming up that capital with the right expertise and the right partners in the right sectors. Then we've seen this huge wave of capital looking at the alternative sector, and people trying to find a bit more yield and looking into the fundamentals of the demographics and that. But of course with that you've obviously got operational risk, and for example in the UK, and John will know this better, but quite a lot of the, for example, student housing platforms have already been bought by quite a lot of the big players. So I think these investors are a bit concerned about what can I buy and how can I buy it. And then the other final strategy really is people going into debt, which I think is quite interesting. So they're the kind of 4 strategies I'm seeing from around the world. Obviously Europe is still benefiting a lot from that capital.
Okay, and on a personal basis, I've been going into debt for many years, which is the problem of encouraging too much population growth in my own family. Very expensive business. Alexander, let's pick up a little bit. Debt mentioned there, but also I had a question coming in specifically. So thank you for that. Which is on the impact of the US interest rate rise. Will that have any impact, do you think, in terms of UK, Europe, whether that's to do with capital or whether that's to do with sentiment? What's your sense of that?
Well, I would first like to thank whoever asked this question to pointing it to me, so thank you. That's a real difficult one. If we think back for a second on one of Walter's really great slides, it showed that there is an economical cycle overlaid by a quantitative easing cycle. One was red, one was blue. And so coming to your question about interest rates, they were driven in the past by economics and then are driven by politics. And if you look at asset allocators globally, they look at what returns do I get in the different asset classes, what risks do I have, and how long am I committed, or liquidity question. And the third one is what happens to my exchange rate. And now if you look into a rising interest rate environment in America, you will see the dollar probably strengthening, although the Trump administration does its best to prevent that, which makes the returns in other currencies lower, because even if you get 5%, the currency falls by 10, you still made a loss. And so I believe that the interest rate cycle in America, combined with the reduced buying of the ECB, because their balance sheet is in a complete mess. If they were a commercial bank, probably the ECB would call itself in to explain themselves what their balance sheet looks like, but European politics work slightly differently. And so I believe that that is one of the main risks, that people start repatriating capital away from Europe. How large that impact is questionable, because when we have 100 trillion running around and we have a market where all of us have the main question, where do we get enough product? Whether that then changes pricing quickly, I don't believe, but it is a trend that we should be mindful of. So the Americans setting the interest rate cycle, and the Europeans having to follow, because bond buyers will also allocate their funds where they get best returns. I think this is something that will drive up the interest rate curve, so the economy will have an impact on that, and at the same time reduction of quantitative easing will squeeze things, and that's where I see a little bit of a repricing starting.
Okay, good. We've got another couple of questions coming in as well. Let's just pick these up. Starting with you, John, just in terms of the, and feel free to pick up any points that there's been there earlier. Just in terms of your view on political risk, let's take the UK. How do you see this impacting on asset prices? What's your sense of it in terms of political risk, by which I assume we're looking at Brexit more than we are about what's happening in Italy, for example? What's your sense of how that's impacting now and in the future?
I think many of these risks were overstated at the time. There's nothing the real estate market likes more than a self-inflicted shock to recreate pricing and add value and leverage on the back of its own value and then prove to itself it was right. So it's a self-fulfilling prophecy. If you look at, and let's go to granular political risk, look at Indy Ref 2 in Scotland. We've kind of forgotten all about that now. I see people merrily now talking about Glasgow yields being the same as Manchester on offices. Well, in theory, assuming rental growth prospects are broadly equal, then that sort of means you've discounted the whole idea that there is any political risk about Scotland. And whether you believe that or not is a different political issue. But Brexit sort of came and went. There are micro sectors, city, office, rents and demand might be one of those. But outside that, we seem to have broadly forgotten about it. And I think, you take the macro view that says, actually, Europe is only, I think Walter's view was 18% of UK. The 18% of the UK economy is directly affected by what happens in the EU, and a big swathe of it isn't. So broadly, we've not seen substantive risk on that. Interest rates are a slightly separate issue, and the longer term will prove on that. But I build on the comments of the other guys. The search is desperate for yield. Everyone looks around the world for income in all manner of asset classes. That fulfills itself in real estate. And everybody is trying to maintain income returns without getting too scary and crazy up the risk curve, or at least convincing themselves they're able to manage that risk in a better way than before. The halcyon days of 2011 have been and gone. Then you could buy a big portfolio from a failing bank. You could repaint the front door a different colour. You could sell your asset for 50% more than you bought it for the previous week, and you could claim that you were a genius, and then you'd eat, sleep, repeat. And happy days. I mean, sorry guys, that world sort of ended, and now it looks more like a sort of multi-dimensional onion. You've got to drill into sectors and types and classes. You've got to take some operational risk without finding yourself running a fleet of ice cream vans just simply to own the dairy. And you've got to work hard at achieving those returns to outperform your investor objectives, certainly if you're an asset manager, to make some profit and returns out of it. And I don't see that changing over the next 2 to 3 years.
Okay, good. And Simon, just coming from you, just to put that in a broader European perspective, how do you see the risks in the UK, political risks in the UK, compared to the other areas that you're investing in?
I mean, one thing I'd say, Richard, and it kind of echoes John's point really, is that I think everybody has now come to terms with the idea that political risk is not just a UK or an Italian or a North Korean or a South Korean or US, or it's a global phenomenon. It's everywhere as in part of the system. I think the way in which investors tend to view things is to look through some of the short-term noise and to say to what extent, and if I'm perfectly honest, to what extent is a central bank backing up the real economy in the conduction of its policy frameworks. If the central bank says, listen, we're going to stand behind this no matter what the politicians say, I'm not sure the markets really care that much. And that seems to be the evidence of the last 10 years, is you can have a lot of global political challenge, you can have some economic challenge, but as long as central bankers continue to act in the way they have over the course of the last decade, most people kind of will look through the risk. Doesn't mean to say the risk isn't there, it just means that there's sufficiently strong palliative care in place to make sure that those risks don't necessarily erupt at any one time and take down a single economy. And I think thus far the central bankers have sort of behaved themselves. The test for the next 5 years is whether, to Alexander's point, whether they all continue to act in a coordinated fashion in the defence of the stabilisation of the real economy in challenging circumstances. I don't expect that they're going to suddenly go rogue and do things that aren't consistent with what they've done over the next decade, and I don't think any investors do. I think everybody kind of looks at those risks and says, right, the ECB isn't daft. And so I think there's a contrast. These risks exist. The investment community right now cares more about other things because it's comfortable that there is a somewhat flexible safety net that sits below it. The continued existence of that safety net is predicated on central bankers continuing to behave rationally over time. Who knows whether that's going to be the case, but right now, given people's return needs, their liability profiles, people are prepared to believe that that's going to continue to be the case.
And in terms of your investment weighting, have you, after the Brexit vote, has that made you change your strategy in terms of the UK? Have you overweighted, underweighted?
Yeah, I mean, you can't ignore the fact that the UK's just sliced a chunk of its potential competitive advantage away over the course of the next decade. So I think what you're seeing in the UK is an adjustment to perhaps a slightly lower trend growth rate going on in people's mind's eyes. And so historically the UK's always captured a much larger share of net transaction flow because of the effects of London partially, but also because it's been a gateway to Europe. So its economy is 25% of Europe's economy, but its share of transaction flow has been up to 35%. I think there are a lot of people now sitting back and saying, well, hang on a second, can it continue to command that disproportionately large share of transaction flow? And maybe people are coming back towards a position where, well, it has to have a place because it's a big economy and London's an important city and so are all the other regional cities, but it's now not in a box seat to take a disproportionate share of everybody's net flows. So I think we're all kind of looking at it and saying, listen, we need to think again about that. Whether that means we're going to be overweight or underweight, I think that will play out over time. I just think it's much harder now to make the case for being massively overweight than it was. And particularly when you see other cities, recovering and improving their overall performance. So as the rest of Europe improves, it's harder to again make the case for London capturing or the UK capturing a disproportionate share of flows.
Okay, good. And Georg, it would be good to get your perception as somebody who's based in Germany but with a company that's been consistently also investing in the UK. What's your sense of how, I guess also just picking up that point about how you see things like Italy, but also how you see particularly your investments in the UK? Does it encourage you to invest more in the UK, less in the UK? What's your sense of it?
Yes, so on Brexit, so this Brexit encouraged us to invest more. So there were some opportunities directly after the referendum, and we were able to buy some very good assets with some discount. But so finally, I don't totally agree with the opinion that things that the London real estate market is doing good since the referendum. So part of my job is to compare different cities and different countries throughout Europe. And so if you look at the rest of Europe and you compare the time between the referendum and today, then you see in most cities and countries real estate markets did really well. So rents increased and take-up increased and vacancy rates got down. And in London, it has done the other way around. So vacancy rates are 2% higher and take-up is lower. And so I wouldn't say that there's no impact from Brexit. I think things did much better than expected, but not. But they could have been even better without Brexit. Is my view on this. And so finally, our view on London is still positive. So we invest in London. But I think it's more from a long-term perspective. So I think it's not impossible that there will be, or we see this as possible that there is a hard Brexit and things go wrong, and so we invest just in very core assets. And so from a long-term perspective, we see our opinion is that London will remain a global city and the most important financial center in Europe. And so we look on opportunities, but we wouldn't take too much risk for our investment in London and also in the rest of UK.
Okay, and Alexander, you obviously wrote a paper briefly after the referendum result, saying that you felt that it would be positive. Questions just come in as well. Easy to assume Brexit will negatively impact the economy, but where do you see, do you see an opportunity from less heavily regulated markets? What's your take on that?
Yeah, I think the statement that it will be positive is maybe a little bit not exactly how I phrased it. There are a couple of copies back there, and if you want to have a look, and you can't get
it was about 8 pages. So
download it. It was a very brief copy. And you can download it from our website. What I said, because 4 days after, everybody was in complete panic that it's the end of the world, and I said it wasn't. It is absolutely not the end of the world, because Britain has a very strong economy, is the largest trading partner, or one of the largest trading partners of Europe, and it would be economically unsensible for both parties to damage each other, because the European Commission cannot punish Britain without hurting itself. I've also written, and I have it here, good that I took a copy with me, is that the key risk is a European Commission focused on self-preservation and not on members. And I think we're seeing that playing out. Do I see it as dramatic? No, I think the UK has a long history of being a hugely productive and flexible country, and hats off to all the people who over the hundreds of years have contributed. If you go through the city, you look up and you see buildings that are exclusively occupied by financial services. And then have a look at the street names, and you will see that some of them are Goldsmith Road. No surprise what happened there. This is where the Goldsmith were. There's Ironmonger Lane. That's where the ironmongers were. Cheapside, one of the most prominent thoroughfares of the city, was a major market. London was an international powerhouse long before financial services were properly invented. In the coffee shops around what is now the Bank of England, Lloyd's of London started, not as an insurance company, but where the landed gentry gave security for insurable risks with their land. And Britain is a highly commercial nation, very well located, highly educated, internationally integrated. That all has stayed here. And as Walter said, it will take 10 to 15 years until financial services and the whole ecosystem is recreated in Frankfurt. Really? A city of 700,000 and a city of 7 million can offer the same. In Paris, with the tax rates, and where someone who loses SocGen 4.5 billion because of rogue trading goes to the employment court and then gets vindicted and said, yeah, you were fired unfairly. I just am not entirely convinced that that is the environment where people will rush to go to. So I think it will be much, much less negative than people believe. I'm worried a bit about the real economy. Can parts be exported back and forth? Do we have a hard border? What's the technical delay of shipping goods back and forth? But I really think that overall, if we all concentrate on doing our job, telling everyone that Britain is open for business, London is open for business, and going about our business, let the politicians do what they need to do, and let us worry about business, and I think both sides are best off.
Okay, good. Mental reminder, must invite Alexander to the Paris briefing. Good. Look, I don't want to spend too much time on these, more time on these broader issues. Let's try and dig down a little bit into some of the sectors. I will just quickly flash this up, though, because so that was the voting so far. Full 5 to 10%, 44%. I like somebody's gone catastrophic there. That's always encouraging to have somebody who's looking, who's looking at that side of it. Interesting to see that, and that mirrors actually some thoughts that you got back as well, didn't it? So yeah, good. Let's look a bit at the sectors. So John, let's start with retail, because the questions come in on retail and a question on office. So I'll start with these two, and feel free everybody to come in on these with your own particular views on it. Serviced offices, something coming in on that in terms of WeWork. How will this impact the office market? What's everybody's view on that? But also retail, and the question came in, which is specific to the UK, but I think it's also runs across continental Europe as well, in terms of the negative sentiment around retail at the moment. How do you see that? So let's pick those two sectors up, particularly for the UK, John, and feel free to update us on any other sectors that you see as particularly positive.
With deference to my specialist retail colleagues as well on this, let's start with retail. Retail's obviously not just economic, it's structural, and at the heart of what's happening is vaguely structural, and then sat around that is all kinds of other things relating to minimum wage, rates, availability of space, change of use style, the way that people spend their leisure time and their leisure pound on doing it. And it's been happening for quite a long time, and we've seen almost a perfect correlation of movement of pricing downwards on retail compared with upwards on industrial and last mile delivery, which has clearly reflected what's happening there. Retail, the sector has struggled, and rents have gone down, and everybody's read the stuff on the CVAs, and then all the other retailers demanding that if somebody else has a CVA, then they shouldn't pay the rent either, and then there's an impact on what that means for leases, and are leases worth anything, and should you just set fire to your lease and do whatever. I think it's almost looking quite interesting. In the last 3 to 4 weeks, I've seen 3 different investment groups all have said, what do you think about shopping centres longer term? And I think the trend from next year, they're probably one of my top buys for next year. And I think that, you're still not going to buy the 4th best shopping centre in Darlington, other than for a fire insurance job. But what you are going to do is focus on those centres where there is a low quotient of fashion, because it's fashion really, and I think we need to split retail properly into fashion and non-fashion. If you go to a centre that's got a Waitrose Superdrug, then it's fine, because it's a day-to-day convenience centre, and if it's got entertainment, so much the better. If you go and see the Trinity in Leeds that Landsex have built with the food court, where they bring in and out the pop-up burger vans and the things, and you see how heaving that is every lunchtime, that's a really quite interesting concept of what entertainment space looks like. So I think retail will rebase, pricing will go down. Eventually, unfortunately, some of the US private equity firms that have backed a number of the asset managers will quietly slip out the back door and accept losses on some of the things that they bought into. But it will create a whole new generation of investment platform off a lower base, and that'll be broadly, knock half of it down, concentrate on convenience, and then build a new town centre use involving entertainment and residential and whatever those other uses are around it, with a healthy dose of local authority intervention thrown into it, because eventually local authorities will not let their towns go to the wall. You look at what Rochdale have done, which is effectively, stump up or guarantee 100 million of investment into central Rochdale. But broadly, what was their alternative? They couldn't sit there and hope the market would work for them, because it was never going to. And the same's happening in Stafford, Liverpool, and even in towns in the southeast as well. So that's my retail summary.
Yeah, does anybody else want to pick that up? I mean, I'm slightly disappointed. I've just bought the 4th, Darlington shopping centre, but I mean, that's just... in terms of European trends or UK trends, anybody want to pick up retail?
I'll brief comment. I think John's right on the UK stuff. It's a real challenge. There's cyclical factors, there's secular factors. And everybody talks about them an awful lot. So I think you have to split retail into component parts. I think shopping centres are a particular component of retail, and there's a huge difference between a sort of small market town centre, shopping centre, and the big regional malls. And there's another difference again between those and retail parks. There's another difference again between those and factory outlet schemes. So you've got to kind of break retail into its component parts now and talk about those individually. But there are going to be, there's some pain in that, that 4th shopping centre in Doncaster town centre, wherever it is. On the continent, I think you see a little bit of a contrast. You've got much stronger underlying retail economics in a number of countries, and you've got not nearly as much supply issue. So, one of the prima facie problems for the UK is it's got too much mid-market apparel-oriented retailing. You don't see that on the continent. The consequence of that is investors just don't look through some of the secular issues. So they're just more comfortable where they have convenience-oriented centres that are in protected catchments, where there isn't a supply-side problem and where the economy's a bit stronger. So, we're selling shopping centres in Germany at 5.5% and 6% cap rates, which is materially different from the price you'd get for a like-for-like centre trying to sell it in a good city in the UK. And I think that is why you're starting to see some interest from people. People are starting to think ahead about what happens when you clean out some of this capacity excess as a result of all of the restructuring and redevelopment, and you get the retail sector right-sized for the tenant base with the right tenant mix. There's no reason why it can't be a mainstream investment for people. And the interest is in that transition occurring in the UK. You don't see anything like the same dynamics in Europe, except where you see real supply or real development activity, where people have built too much over the last 10 years. But for most cities in Europe, that's not really the case in the way it is in the UK.
Okay, good. Yep, go ahead.
I'd like to add a little bit to this. Our job predominantly is to explain and present the investment or the financing opportunity to lenders. And we write 10 pages, 30 pages, 130 pages, depending on the complexity of the asset. And recently someone came to us, an overseas investor. He had this secondary retail portfolio and said, can you help me? And we said, well, let's first see whether this is really the right thing for you to buy. We advised him in great detail, advised him against it. He listened to us, so our fee was gone. But it was the right advice, because I think there are a few further steps that we have to look at. We have an oversupply of retail square meterage in the UK. I come from a retail family, every meter you have in your shop has to create a certain turnover. And that means you need to have population enough, with money enough to pay for that. Now we have two challenges. First of all, part of the population is not going into the shops to buy, it diverts to the internet. We've discussed that. Another part of the problem is that much of the younger generation is much more experience-oriented, and you do not buy experience in a shop. You go overseas traveling, or you go to a festival, and if you look at concert tickets, what they cost nowadays, these things are all experiences. That means that the pool of cash actually available to pay the rent for every square meter of retail that is in this country is simply too small. And that hits everyone. That hits the select suppliers, House of Fraser, as much as the volume retailers, Marks and Spencer and Tesco. There is just a shift not only to the internet, but what people consume with their constrained amount of money they have after an extended period of negative actual income after inflation. And so the square meterage has to reduce first before this becomes a viable sector again, and then you will be able to pick out some pockets. And sitting with our clients, we analyzed all this, and I think right now a large area of retail is still a falling knife that you shouldn't rush to catch. Some areas like outlet centers, which offer something different, may be different, but overall I think it's an area. I think there will be selective buys if you're well advised, no question, but overall I'd be very, very careful. And financing for it is not very easy. I'd like to add that as well. So you really need to explain to your lender why he should even put 50% LTV, whatever V is, or LTC, that is at least clear, into that, and at what pricing.
I mean, I just want to try and pick up some of the other points that are there. You've got the point about coming in quite strongly from the audience as well about technology, the whole WeWork sharing economy things, how those are impacting. We've picked that up a little bit in terms of retail, but how do you see that also for the others? You've got hospitality, you've got, particularly in the office sector, you've got these kinds of different ways of working. How much of an impact do you think that will have? Or do you think it's simply adding more flexibility into the market and will actually create more opportunities rather than less?
Obviously, WeWork and what they're doing around the world is a huge disruptor, I think. A lot of owners of offices, it's forcing them to become more flexible. And of course, office as an asset class always means far more capital expenditure. So if leases are going to get shorter to be more flexible to compete with the WeWorks, it is a big concern to a lot of owners of offices, particularly in cities like London and stuff. But it's going to be interesting. Lots of questions asked of a lot of people class it very like Regus and that experience, but obviously it's completely different in terms of it's all about members. And I imagine in a downturn, which a lot of people say, we've only seen this work in an upturn, how's it going to work in a downturn? I can see people wanting more flexibility. So it is a disruptor in terms of how people are going to assess buying offices, and will they have to build in capex from day one going forward, for example.
I was just going to say, Richard, I think WeWork's an interesting one because WeWork may well have saved the London office market from the effects of Brexit by simply offering companies who would have otherwise deferred long-term investment decisions for a significant period of time it tempted them into continuing to take office space because of the flexibility associated with the model. So I think whether its business model is crazy or not will only be proven out by the inflection of time and a cycle. But what it has done, I think, in the meantime, has been a very effective bridge for keeping the London office market stable when it could have been much less stable than it has been. The other point I'd make on the technology side is I think it's been a massive enabler to some of the alternative sectors because it's allowing people to get their heads very quickly around business models with very flexible leasing profiles like student accommodation. A decade ago, it would have been very hard to track the way in which vacancy behaves in individual buildings over time and how changed amenities and how rent roll management would affect the ability to lease up student accommodation. I think the same is true of hotels. It gives you the ability to track very quickly how your yield management works. If you can make it easier for people to understand how they adjust their yield profile over time with technology, it's a huge enabler for all those alternatives which traditionally institutions have been wary of because they couldn't understand the leasing risk associated with them.
Okay, good. Let's deal very quickly with locations and that sense of investors moving slightly higher up the risk curve or to more value add. What's the sense of that? And also, just briefly in terms of locations, what's your view? There was another question coming in on the comparative between the cities, continental Europe versus UK. What's your view on that? Let's start with you, Georg. Just in terms of the locations, the cities, is there enough core product? Are people having to move up the risk curve?
Yeah, so I think our investors, there are some of them are heading up the risk curve a little bit. So, for example, recently we bought a restaurant property. I think so. So we have never done this before, and I think restaurants are maybe a bit more risky than offices also. And but finally, we advised them to not to take more risk than in the past. So so this means buy for higher prices or to buy not at all. And yeah, but finally there is in Germany, for example, there is definitely more interest in e-cities, for example, and also on industrial maybe, and more into the in general. There's a strong interest in niche segments, and I think there are also good opportunities in niche segments, but you have to be aware of the risk there. For example, we have one fund who is invested in rehabilitation hospitals, and so this works really well, and from a risk perspective it looks good to us. But for example, if you look in other segments like nursing homes or so, these markets are quite intransparent, but you have some information. For example, if you look at rental growth, this is negative in real terms, and so it's you need a lot of research if you go into these niche segments to be sure that you don't take too much risk.
Okay, good. And Alexander, we haven't really touched much on the financing side, but what's your view of that at the moment? How do you see that? Let's look at the outlook for the next 6 to 12 months.
Okay, we work UK, Germany, Netherlands, a little bit Spain, France, and Italy. So I'll concentrate on those countries. I think we are in a financing market that is pretty unique because everything sensible that came onto our desk, we got finance for, and not only finance for, but really attractive finance for, with record low margins, very high LTVs, sometimes long-term without amortization, and. So the banks are very keen to put out money, but what has changed, and that's an advantage and a disadvantage, is every bank is much more specific what they want, and you have to put the right proposal very carefully explained to the right bank, and you will get very good terms. If not, you will very likely get a no. And if you know something is not what the bank likes to finance, however good your relationship with them is going to be, they will struggle to do it. And we mostly work in the value add, and we've seen exactly what you said, people moving out of the B locations in A cities, where they had value add activity because they had partially empty assets that they refurbished, relet, or like you said, bang in the middle of town, and it was just the right point in time, into C cities, into more management intensive areas, into hotels with leases, into management agreements, smaller cities, more complex assets, industrials, and more operational activities like student accommodation and similar. And on a national level, you'll see the same. Whereas in the past, value-add investors found a lot of opportunities, and good people like Tristan are a good example. In the UK, they then moved to the continent, Germany, France, and now they're moving further and further south. We talk to people in Spain, people are looking into Portugal, which is a very small market. Italy is becoming very interesting. The search for yield is everywhere, and you have dedicated and competent banks following and enabling this transition, because equally the banks are under the same pressure. They also have to deploy into sensible assets and get a sensible return, because if they put their money back to the ECB, Mr. Draghi claps his hands and hands them a little bit back the next morning. And that's for a bank a very difficult situation.
And let's quickly just cover development, redevelopment. John, what's your sense of that in terms of the opportunities here in the UK? Do you think, I mean, there was a lot of talk in Paris yesterday about development and redevelopment because a law had recently been changed that allowed you to repurpose office into residential. What's your sense of the opportunities here in the UK for development, redevelopment?
In summary, lots of aspiration to do development and lots of things to go and develop. A big challenge in financing it, really, in many areas. That's both banks in terms of what they'll give on loan to cost, and it might say, you know, if you walk past the bank, it says loans available. If you go inside and mention the word development, strangely, there's nobody at any of the desks. They just don't want to be seen to be doing it. I think that's partly lack of teams and expertise, but also perceived levels of risk around doing it. So, you know, there's a lot more hope to go and do it, and there are some key sectors where there's lots of things to go and do. Second wave of student developments, retirement villages, private hospitals. You know, there are some cities where there's been no grade A development for 10, 20 years, where there must be market in doing that. That's not about expansion, that's just about repurposing and redevelopment, and the shopping centres are referred to with lots of things to do. There is a skill set, there are some construction cost issues, and there are some financing that I think will make that slower than would be the case. So I think, you know, demand and ability will outpace it. But, you know, and you've seen that in the construction figures, you've seen that in the amount of new starts going on, and you've seen that in the amount of completions. That will in turn probably constrain supply and probably keep pricing high as well. So I think it'll be a bit of a Mexican standoff.
I've got the last question that we always ask here, just to try and focus our minds on what the investment opportunity is and focus it back onto the real estate side. So you can look at countries, regions, sectors. What do you think has the best investment case? Looking forward, we'll go quite short term on this, I think. So if I've got something to invest over the next 6 months, where should I invest it? You can choose Europe, you can choose the UK. Where should we start? Let's start with you, Simon.
I'm just gonna pick up on what John has just talked about, which is development. I think he's spot on. There aren't enough buildings being built to really cope with building obsolescence, and there's some major issues around financing it, which I think means the returns available, if you pick the right building, right location, right market, are going to be pretty good on a forward-looking basis relative to what people have been able to get elsewhere.
Okay, good. Georg.
So Edinburgh looks really good to us. So pricing is quite good, and I think there is some risk premium included in the prices, and construction activity is very low. Vacancy rate is very low. So Edinburgh offices looks really good to us, and maybe from a German perspective, we think Berlin will, maybe it's more a long run bet that Berlin will further improve. So I think in most European cities, in most European capital cities, rents are higher compared to the rest of the country, and in Berlin this is still not the case. And so if Berlin develops to a real capital city, and so rents should increase, and so we're quite positive on Berlin finally.
Okay, good. Richard.
I think looking at the sectors, very much the mixed use in core CBDs, I think, is a really good bet. You know, it's what we're seeing the occupiers want: amenities, residential, along with commercial offerings. So, you know, and I think we've talked about there's been a lack of development this cycle, but there's also been a real lack of infrastructure, and I think there is a lot of expectation that infrastructure is going to improve over the next sort of 10, 15 years around the world. So I think anything tied in with infrastructure as well and mixed-use development is a good thing. You know, obviously you can't ignore industrial at the moment and the fundamentals there. I mean, in terms of locations, I mean, you mentioned Berlin. It's been the hottest market for the last couple of years. The fundamentals are very strong, but you know, the growth of Berlin becoming the third largest city in Europe, and it's becoming a lot more multicultural, and it's far more affordable for the young to live, I think is a hotspot. I mean, we're seeing a lot more activity in Central and Eastern Europe, and I think what the game changer there is, there's a lot more local which is creating confidence for international money to go into those markets. it's always had to rely on international money for its exit, but I think the Polish going down the REIT system, and I think all 35% of all transactions last year were done by Hungarian funds or Czech funds, so I think that's quite an exciting area to get in, but of course you've got to get in at the right time and get your timing right.
Okay, good, thank you. Alex?
I would go either to the UK and Germany, because I feel that those are countries that are stable and will develop well. There are 3 sectors I would concentrate on, and that is office in a good city in a central location, because I believe that that will continue to grow. It doesn't have to be London, but you can do very good things in Leeds or Manchester and stuff like this. So office, I still believe in the residential story, and also uses that are similar to residential, be it student accommodation, and I'll also like the industrial sector. And in all of those, I would never touch a finished prime product, because there's nothing for me to do and nothing to protect myself if yields shift. I would always look somewhere where I can either develop, redevelop, add on, change of use, permitted development, whatever it is, to have an angle to create value. And because we can get all these things financed, I think I'll still have a quite decent return, because we mustn't forget we still have interest rates at a historic low, and what we've achieved recently, the cash on these things once they're through this little process is still phenomenal, and that's what I'd be looking at. Rather not so much on the capital uplift, but on a long sustainable cash flow. That it doesn't have to be a 25-year lease, but a good enough asset that I can always replace the tenant with another one.
Okay, good. John?
I'll stick to the UK, and I'm kind of with the others. The best office building, short term, the best office buildings in secondary cities, particularly Edinburgh, Leeds, Liverpool and Reading, would probably be my top 4 in terms of where I'd go. Longer term, and if you wanted a punt, I'd go probably more healthcare, students, lifestyle, demographic driven issues, and certainly retirement villages I think is going to be a key growth sector over the next 10 to 15 years. And in a search for yield and return, don't be scared to take a lot of risk, but only take one risk on every asset. So buy the best building in town completely empty, but don't end up leveraging risk on risk on risk with the belief that leads to success, because I think that's just a nasty way to go. And avoid really scary looking operating businesses in random parts of the investment universe.
Very much the ABBA strategy. That's what the Koreans like to talk about. So, A locations, B buildings, B locations, A buildings.
Okay, good. Thank you.